Something is happening to gold right now that breaks every single rule you have ever been taught about it. And I don't mean that as a figure of speech. I mean that this week, gold did the mathematical opposite of what every textbook, every headline, and every instinct says it should have done. And almost nobody is explaining why. For 2 days, the United States and Iran exchanged airstrikes, the most serious military escalation since their fragile ceasefire collapsed. American forces struck roughly 170 Iranian targets. Iran fired back at U.S. military bases across the region. Missiles slammed into commercial tankers in the Strait of Hormuz, the narrow channel that carries a fifth of the world's oil. This is the exact scenario, the precise crisis that is supposed to send gold exploding upward. War in an oil region, a choked choke point, the threat of a wider conflict. And gold fell. It dropped to around $4,000 an ounce, its lowest level since November. Then today, something even stranger happened. A rumor surfaced that Iran wanted to make a deal. Oil prices eased, and gold, the so-called ultimate safe haven, the asset you are told to run to when the world catches fire, went up, more than 1%. On the news that the war might be calming down, stop and sit with what you just heard, because it should not make sense. War escalates, gold falls. War calms, gold rises. That is the exact inverse of everything you have ever been told about how gold behaves in a crisis. If you own gold right now, this is the single most important thing you could possibly understand, because it means the model in your head, the one that says gold is your insurance against chaos, is broken. And once I show you the model that actually works, you will understand not just what happened this week, but exactly what is going to drive the price of gold for the rest of this year. There is a single number arriving in just 4 days that will decide the entire thing. And there is one buyer, quietly, relentlessly, doing the precise opposite of everyone else. Stay with me, because by the end, you will see this market more clearly than the people writing the headlines. Let me start by taking the myth apart, because everything else is built on top of it. The belief that gold rises on fear is the most widely repeated and least reliable idea in all of investing. It feels true, it sounds true, and every so often, in a short window, it even looks true. But fear is not the engine that moves gold. Gold responds to something far more precise and far less emotional, the real return available on the alternative to holding it. That alternative is a government bond. And what actually drives the price of gold is the yield on that bond after you subtract inflation. Economists call it the real yield. When that real yield rises, gold falls. When it drops, gold rises. Across decades of data, that relationship holds far more consistently than any connection to war or crisis or fear ever has. So why does that matter this week? Because it explains the whole paradox. Let me walk you through exactly what a war in an oil region does, step by step, because this is precisely where your intuition breaks down and precisely where the opportunity to understand hides. When conflict threatens oil supply, the first thing that moves is not gold. It is the price of oil. Oil spikes. That part is obvious. But here is what most people never trace. Because oil is buried inside the cost of nearly everything, the shipping that moves goods, the fuel that runs farms, the energy that powers factories. A spike in oil pushes up inflation expectations across the entire economy. Every business that uses energy, which is every business, now faces higher costs. Those costs flow into prices, and rising inflation expectations force the Federal Reserve to keep interest rates higher for longer, because raising or holding rates is the only real tool it has to fight inflation. Now follow the next link, because this is where it turns on gold. Higher interest rates push government bond yields up. And when a bond reliably pays you 4 or 5%, a metal that pays you absolutely nothing, that in fact costs you money to store and to insure, becomes far less attractive by comparison. Why would a large institution hold a lump of metal earning zero when it can hold a government bond earning a real return? At the very same time, capital fleeing the chaos rushes into the US dollar as the reflexive safe haven. And because gold is priced in dollars all over the world, a stronger dollar makes gold more expensive for every buyer outside America, which crushes global demand at the exact moment fear is supposedly at its peak. So follow the entire chain the whole way through, one link at a time. War raises oil. Oil raises inflation. Inflation keeps the Fed aggressive. An aggressive Fed lifts real yields and strengthens the dollar. And high real yields and a strong dollar are the two most powerful forces on earth for pushing gold down. That is why gold fell as the missiles flew. Not because gold failed at its job, but because in a world where the Federal Reserve is already terrified of inflation, a fresh oil shock does not deliver the rescue that gold owners are praying for. It delivers the opposite. It locks the Fed in place or pushes it to tighten even harder. This is the part that almost no one has adjusted to, and it is the absolute heart of everything I am telling you today. For most of the last 20 years, a crisis was good for gold because a crisis meant the Fed would ride to the rescue with lower interest rates and a flood of easy money, and easy money lifts the price of gold. That link, the one every gold investor internalized over 2 decades, is now completely severed. Today, a crisis that raises oil raises inflation, and inflation keeps the Fed's hand frozen. The rescue is not coming because the rescue itself would make the inflation worse. War used to whisper, easy money is on the way. Now it screams the exact opposite. And that single inversion, that one flipped switch, explains why this entire week looked so upside down and so wrong to everyone watching it through the old lens. And I want to be clear, this is not my private theory. The Federal Reserve confirmed it in black and white this week, in a document that most people skimmed right past. The minutes from Chair Kevin Warsh's very first meeting were released, and they revealed a central bank split almost perfectly down the middle. 9 of the 18 officials who submitted projections now expect at least one interest rate hike before the end of this year. Read that again, not a rate cut, a hike. In an economy where a rate hike was considered nearly unthinkable just months ago. And it gets sharper. The Fed's own staff raised their core inflation forecast by 0.6 of a percentage point in a single quarter, a massive revision in that short a window, while simultaneously cutting their forecast for economic growth. Sit with that combination for a moment. Weaker growth and hotter inflation at the same time. That is the single hardest situation a central bank can ever face. It is called stagflation, and it is the single worst possible environment for a Fed that might otherwise want to rescue falling markets. Because the tool that rescues markets is the same tool that makes inflation worse. For gold, this is the entire story in a single sentence. As long as the Fed refuses to take a rate hike off the table, the dollar and bond yields stay elevated, and every single rally in gold runs straight into a ceiling. The war did not break through that ceiling. It reinforced it because the oil spike the war produced makes the inflation problem worse, which makes the hawks on that committee even more determined to hold firm or tighten. So now you understand why gold fell as the war raged and why it rose the very moment peace seemed possible. It was never about the war itself. It was about what the war does to oil and what oil does to the Fed. The market has stopped watching the battlefield. It is watching the oil price because oil is the fuse and the Fed is the bomb. Every peace rally this month has been sold, and every escalation has been bought in reverse for exactly this reason. The traders have quietly figured out that the headline about the war is not the real signal. The real signal is what comes 3 links down the chain. But here is where it becomes genuinely urgent, where this stops being an explanation of the past and becomes a map of the next few days, because there is a number coming in 4 days that overrides everything I have just described. June's inflation report arrives on July 14th. And this one figure, this single data point, will decide where gold goes for the rest of the summer. Let me explain exactly why it carries so much weight. May's inflation came in at 4.2%, the hottest reading in years, and the specific number that pushed the Fed into its hawkish split in the first place. And here is the critical detail. More than 60% of that entire increase came from energy, from oil. So the whole question now collapses down to this. What did the oil spike do to inflation in June? If that number lands at or above 4%, the odds of a September rate hike surge back towards 70%. Real yields stay high, and gold stays trapped beneath its ceiling with no way out. But if it comes in soft, if underlying inflation finally shows signs of cooling despite the oil shock, then the hawks on the committee lose their entire argument. Rate hike bets collapse, real yields fall, and the ceiling pressing down on gold simply vanishes. One number, 4 days away. The entire market is now balanced on the head of that single pin. And here is the exact tension almost nobody is holding correctly in their mind right now. The war is pushing oil up, which argues for higher inflation and a capped gold price. But cooling underlying prices would argue for the precise opposite. 2 enormous opposing forces colliding in 4 days, with gold sitting directly in the blast radius between them. That is why the price is whipping violently in both directions day to day. It is not noise. It is the market trying to guess which of those 2 forces wins. Now let me show you the one buyer who is completely ignoring all of this daily noise, because their behavior is, without question, the most revealing signal in the entire market. And it is the signal that separates the people who understand gold from the people who merely watch its price. While traders sold gold on the war news, and while the price sank to its lowest level since November, one specific category of buyer did the exact opposite: central banks. China's central bank just reported its largest monthly increase in gold reserves in more than 2.5 years. Not selling into the fear like everyone else, buying aggressively into it. And China is very far from alone. As a group, the world's central banks, the institutions that literally create and manage national currencies, have been buying gold at roughly double their historical pace for 3 consecutive years now. Think hard about what that actually means. The most sophisticated, best informed, longest horizon institutions on the entire planet, the ones that manage the reserves of whole nations, with teams of analysts and access to information you and I will never see, are accumulating gold aggressively at the very moment the daily price is falling and every short-term signal on the screen says sell. Why would they do that? Because they are not trading the war. They are not trading the inflation report on the 14th. They are positioning for something structural, something deep, that no single headline and no single data point can touch. And that something traces directly back to a single moment that most people have already completely forgotten. When Russia invaded Ukraine, the United States and its allies froze roughly $300 billion of Russian foreign reserves overnight with the stroke of a pen. And every central bank on earth absorbed the same brutal lesson in that instant. The dollars and euros they hold in reserve can be frozen. Reserves held in someone else's currency exist only at that other country's permission. They are not truly yours. They can be switched off. But gold, physical gold, sitting in your own vault on your own soil, cannot be frozen, cannot be sanctioned, cannot be switched off by anyone for any reason. It has no counterparty. It answers to no one. There is no ledger in another country that can be edited to erase it. In that single moment, the world's reserve managers discovered that the assets they had always believed were the very definition of safety carried a hidden fatal vulnerability, and that the oldest, most primitive money of all was the only reserve with no off switch. That realization is the engine underneath all of it, and here is why it matters so much for understanding this week. That realization is permanent. No peace deal reverses it. No rate decision erases it. No soft inflation number makes a central banker forget that their dollars can be frozen, which is exactly why the official buying never stops, no matter what the price does on any given day. It is structural, it is patient, and it does not care in the slightest what happened this morning in the Strait of Hormuz. And underneath even that, there sits an arithmetic problem that no Federal Reserve chair, however tough, can ever escape. The United States now carries a national debt approaching $40 trillion. The interest on that debt alone, not paying down a single dollar of what was borrowed, just the interest, now exceeds $1 trillion a year. That is more than the entire defense budget of the United States. It consumes roughly 19 cents of every single dollar the federal government collects in revenue, and it grows every single day. At that staggering scale, the government simply cannot keep interest rates high forever, because every additional month of elevated rates piles tens of billions of dollars more onto that interest bill, which widens the deficit, which forces more borrowing in a loop that feeds on itself. And the historically consistent escape from a debt this size is not to repay it. No nation in this position ever truly repays it. The escape is to let inflation quietly run a little hotter than interest rates, year after year, so that the real weight of the debt slowly erodes away. It is a hidden tax paid by everyone who holds the currency, and it transfers wealth silently and relentlessly away from everyone holding cash and bonds and toward the one asset on earth that cannot be printed into existence by any government decision. This is precisely why the war and the inflation number, as much as they genuinely matter for the next move, are not the real story. They set the price this month. They do not set the direction over the next decade. The central banks understand that distinction perfectly. It is the whole reason they are calmly buying exactly what frightened traders are panic selling. Now let me be very precise about what I am saying and what I am not saying, because intellectual honesty matters far more to me than telling you a dramatic story. I am not telling you that gold cannot fall further from here. It absolutely can. If June's inflation comes in hot and the Fed hikes this autumn, real yields will climb and gold will face a very real headwind in the near term. In fact, Bank of America just cut its average gold forecast for this year, citing exactly this more hawkish Federal Reserve. So in the short run, that ceiling is real, and you should respect it rather than fight it. But here is the detail that almost every single headline missed, buried in that very same research note. That same bank kept its long-term target at $6,000 an ounce. Read that carefully. The very reason the Fed cannot hike rates aggressively enough to truly kill the gold story, that mountain of $40 trillion in debt that punishes high rates, is the exact same reason the long-term structural case for gold refuses to die. The short-term headwind and the long-term tailwind come from the same source. That is the whole puzzle, resolved in a single sentence. So when you watch gold fall as the war escalates and then rise as it cools, do not read it as chaos and do not read it as gold failing to protect you. Read it as information. Read it as a signal The market is telling you in the clearest possible language it has that the thing driving the price of gold was never the war at all. It was the oil price and the inflation that oil feeds and the Federal Reserve that inflation traps. The daily move on your screen tells you what frightened traders did this morning, but what the central banks are doing, quietly, patiently, relentlessly buying into every single dip, tells you what the most informed institutions on the entire planet are preparing for over the next 10 years. Those two signals are pointing in opposite directions right now. That is the tension of this exact moment. And in just 4 days, one inflation number is going to tell you which of those two signals the rest of this summer belongs to. So watch the oil price, because oil is the fuse. Watch the 14th, because that is when the fuse either burns or goes out. And above all, remember the lesson this strange week just taught you. The loudest headline is almost never the real story. The real story is always 3 links down the chain, and now you know how to follow it.